A few days ago, something happened in the silver market that should make every serious investor pause. Not because prices fell, but because of how they fell. It wasn't gradual. It wasn't logical. It wasn't even what most people would call a normal market reaction. It looked like the floor vanished beneath the entire trade. And here's the uncomfortable truth. When moves like this happen, the public is usually given a clean, simplified explanation, something easy to digest. But the real drivers behind market collapses are rarely simple, and almost never random. If you own silver, gold, mining stocks, or precious metals ETFs, especially inside long-term savings or retirement accounts, you deserve to understand what actually unfolded behind the scenes. Because what happened wasn't just price volatility, it was a structural event. Let's begin with credibility and context. Across decades of financial history, extreme crashes in commodities almost always follow recognizable patterns. The players change, the headlines change, but the underlying mechanics tend to repeat. And this latest silver collapse showed many of those same fingerprints again. On the surface, reports suggested the drop was triggered by speculation surrounding a possible shift in Federal Reserve leadership, a move interpreted as potentially tighter monetary policy. That explanation sounds neat. It sounds logical. But it doesn't explain the scale or speed of what actually happened. Because headlines can light a spark, but they rarely cause an explosion on their own. To understand this event, you have to step back and examine the sequence. Silver had surged aggressively, reaching roughly $120. Momentum was strong, investor participation was heavy, and importantly, leverage in the market was building. Then, almost suddenly, multiple events aligned. Major trading infrastructure experienced outages in key metals pricing venues. Large institutional participants reported system disruptions, and at nearly the same moment, futures exchanges raised margin requirements, increasing the capital traders needed to maintain positions. Within hours, silver collapsed toward the 70s, one of the most violent moves the metal has experienced in modern trading history. Gold followed lower. Mining equities were hammered. Billions in market value disappeared almost instantly. But here's where most coverage stops, and where the real story begins. To truly understand what happened, you have to understand leverage. In futures markets, investors rarely pay full price for exposure. Instead, they control large positions using borrowed capital through margin. For example, someone might control $100,000 worth of silver with only $10,000 deposited. Leverage magnifies profits, but it also creates fragility, because exchanges hold the authority to change margin requirements at any time. When they raise those requirements, traders must immediately deposit more funds, or liquidate their positions. And when large numbers of participants are already fully leveraged, most cannot add new capital quickly. So they sell. And when selling begins, it triggers more margin calls, which forces more selling, which accelerates the collapse. This is how markets transform from orderly corrections into cascading liquidation events. Not emotional selling, mechanical selling, compulsory selling. History shows this pattern repeatedly. In 1980, silver prices exploded during a speculative frenzy before regulatory changes triggered forced liquidation and a historic collapse. In 2011, silver surged again following global financial crisis stimulus. Margin hikes followed. Prices crashed violently. And more recently, similar structural flushes appeared during previous silver spikes. Each time, the mechanism was nearly identical. Crowded positioning, high leverage, rule changes mid-cycle, mass liquidation. The story doesn't require conspiracy theories to explain it. It only requires understanding incentives and structural pressure. But here's where the story becomes even more important for long-term investors. There are actually two silver markets operating simultaneously: the paper market and the physical market. The paper market consists mainly of futures contracts and leveraged financial instruments. It moves quickly, reacts violently, and is highly sensitive to margin adjustments and liquidity shifts. The physical market is completely different. It reflects real supply chains, industrial consumption, mining output, and global demand for tangible metal. And here's the key distinction. Paper markets can collapse in price overnight. Physical supply cannot suddenly increase overnight. Silver plays a critical role in solar energy, electronics, electric vehicles, and emerging data infrastructure. Industrial demand continues expanding in ways that are difficult to replace technologically. If genuine supply deficits exist, short-term paper crashes do not solve them. They simply reset sentiment. Eventually, physical scarcity reasserts influence. There are already signs that physical demand remains strong. One example is regional premium behavior, the additional price buyers pay above spot pricing in high-demand markets. Elevated premiums often signal tight physical supply despite falling futures prices. This divergence between paper pricing and physical demand has occurred multiple times throughout commodity history, and when it persists, volatility tends to remain extreme. Now, there's an emotional lesson hidden inside events like this, one many investors learn the hard way. Markets rarely remove participants because they are completely wrong. They remove participants because they are overextended when conditions change. The most dangerous combination in investing is not incorrect analysis. It is correct analysis combined with excessive leverage, because leverage eliminates the luxury of patience. And that brings us to risk management, the most ignored yet most powerful wealth preservation tool available. If a position is large enough to disturb your sleep, it is probably too large. If moderate market swings create emotional panic, position sizing is likely misaligned. And if volatility can force liquidation, leverage has already placed control outside your hands. Successful investors do not just predict outcomes. They build structures designed to survive worst-case scenarios. Different instruments carry different volatility profiles. Silver historically experiences sharper price swings than gold. Mining equities often behave like high-beta versions of underlying metals because they are subject to stock market liquidity cycles in addition to commodity pricing. Understanding these relationships allows investors to align exposure with emotional tolerance and time horizon. Because volatility is not just a financial test, it is a psychological test. Another overlooked reality is that large financial institutions and exchanges possess deeper visibility into market positioning, leverage levels, and liquidation thresholds than the average participant. That informational advantage doesn't automatically imply wrongdoing, but it does reshape the playing field. And investors who ignore structural dynamics often mistake them for randomness. Looking forward, the most important question isn't whether volatility will continue. History suggests it will. The real question is whether underlying demand fundamentals remain intact. If industrial demand and physical supply constraints persist, sudden liquidation events may create temporary price distortions rather than long-term trend reversals. If demand weakens significantly, recovery periods can extend much longer. This is where disciplined analysis becomes critical. Let's simplify the entire event into 3 essential insights. First, the catalyst may have been policy speculation, but the collapse was driven primarily by leverage colliding with margin changes inside a crowded trade. Second, the crash reduced speculative positioning, not necessarily real-world supply shortages or industrial demand. Third, future investment decisions should prioritize durability, balancing time horizon, position size, and exposure type to withstand forced volatility. Financial markets are entering an era shaped by rapid policy shifts, evolving monetary systems, and structural liquidity changes. These transitions historically produce both enormous opportunity and enormous risk. Investors who survive volatility cycles often outperform those who attempt to perfectly time them, because long-term success rarely comes from predicting headlines. It comes from building strategies capable of surviving the unexpected. And perhaps the most important takeaway is this. When markets collapse suddenly, ask yourself one simple question. Who was forced to sell? And who had the resources to buy? That single question reveals more about market structure than any headline explanation ever will. Because markets don't move purely on news. They move on positioning, they move on leverage, and they move on who loses the ability to stay in the game. Understanding that difference is what separates reactive investors from prepared ones. Stay informed, stay disciplined, and above all, stay positioned to survive the moves most people never see coming.